are at another video for to review the questions that we have for the course. Now, for today's video, we're going to look at the questions which were based on Workday 3, otherwise known as Topic 4 questions. So this has to do with capital budgeting techniques. So these are the techniques that we use in order to be able to ascertain whether a certain project is a worthy investment. So you can use this for lots of different areas within your own department or even within your own personal life. The idea with much of the approaches here is that the project is the present value, the value of a project is the present value of its projected future cash flows. So that's something that we emphasized quite a lot in the classroom. So let's go ahead and have a look at the kind of exam questions you could get for this topic. Okay. So suppose you have a company, or suppose a company is considering investing in a new project that requires an initial investment of 500,000. And now you've got your cash flows. Your expected cash flows are 100 in the first year, 200 in the second, 250 in the third, 200 in the fourth, and 150 in the fifth year. Okay. Let's imagine that the company cost of capital is 10%. Now, you'll see the word discount rate or required return or cost of capital used. They all mean the same thing. Okay, it is the or in the present value equation. So just to reiterate that point, we called it discount rate or required return, but it can also be cost of capital. How much that capital is actually costing you to invest. Okay. So what we want to do is we want you to evaluate the project using the following capital budgeting techniques: NPV, IRR, payback period, and profitability index. So each of the topics are, each of the questions are listed there on A, B, C, and D. And we also have topic E, which asks you to compare and contrast the strengths and weaknesses of each capital budgeting technique. Okay, so without further ado, let's go ahead and see how this question is answered. So our first one is calculate the NPV for the project. So the NPV, the clue is in the name, net present value. So we look at the present value of all the future cash flows and we net this off against our initial investment, which is already given to us in present value terms. So our cash flows would be those expected cash flows, or would be the cost of capital, and N is the number of years. That's also denoted as T in our formula. So when we do that, and we've done this quite a lot in the class, we see that each of these cash flows, are when they're brought back to present value terms, they've got to be less than the actual cash flows as they're expected. So that's a handy way for you to know that you're doing it right if your cash flow is less. So for example, in year one, that year one projected cash flow is 100,000. If you bring it back to present value terms, you'll see that it arrives at 90,909. Okay, and so on. And so the netting aspect to this will be your 500,000 is your cash outflow against all those inflows. So we see then that the NPV for this project is 173,767. So because the NPV is positive, it is acceptable. Remember the NPV rule: if the project is equal to 0 or positive, you can accept. If it's less than 0, you reject. Now, why do you accept when it's at 0? You accept it at 0 because at least you're making the required return. In this instance, at least you're making the 10%. And that's compensating you for inflation, the opportunity cost, had you invested in risk-free rate bonds, and the uncertainty attached to the investment itself. Now, in the second question, it asks you to calculate IRR. Now, from the class, you'll realize that this is rather an arduous calculation, so we would have to use a trial and error approach or a financial calculator in order to do it. When we use a financial calculator, the steps are relatively simple, but you don't all have financial calculators, so I will not be asking you to calculate IRR in an exam situation. Okay, maybe something that you would see later on if you took an MBA course, you'd have to calculate it. You can, of course, calculate it with Excel as well, should you wish to. So the IRR for this project is 22.08%. Okay, because it's greater than the cost of capital, which is 10%, then the project is acceptable. Okay, so if you want to know how to calculate the IRR, can I ask you to just return to the class notes and you'll see an example of how one is calculated there. But I would rather that you understand the value of IRR and why we use it alongside or in place of NPV. It's simply because it gives us a number, a return figure, which is easily communicable to our audiences. Remember, if you're a finance manager or if you're planning a particular project, it's quite possible that you're pitching this to investors, in which case you'd need to sort of give them a number that they can really work with in their own mind. So an IRR gives you a greater intuitive value than an NPV, which simply tells you you'll earn your 10% back, and then you'll get, or the company or the project will deliver a certain amount of money. If we were to calculate the payback period for the project, we need to find the number of years it takes to recover that initial investment. Okay, so effectively how we calculate it is we take our years before the full recovery plus the unrecovered cost at the start of the year, that is the cost we've got left, divided by the cash flow during that year. Now, we did this in class, but essentially what you need to do is you need to pay particular attention to what you've got left in that last year. So in this instance, we had 2 years worth of cash flows that still didn't bring us to the required amount. That was our initial investment. And then we had still 200,000 left to recover in year 3. And so we put this over the projected cash flow in year 3. So 200 over 250 equals to 2.8 years. Okay. Since the payback period is less than the project's expected life, you could say in this instance the project is acceptable. Oftentimes with payback periods, the investor might say, I would like my money back within X number of years. So it's a rather arbitrary number, and it's a rather arbitrary way of making a decision. Okay, the next thing we want to do is we need to calculate the profitability index for the project. So let's go ahead and see, can we do that? Okay, so the profitability index allows us to compare different projects by simply standardizing the present value of the expected cash flows by that initial investment. Okay, so here we're taking into consideration the time value of money, okay, and we're putting it over the initial investment to give us an idea of the profitability. So looking at this, let's just go across here and up. Okay, so our profitability index is all of those cash flows brought back to present value terms as you'd expect in the normal way we do it. Okay, which is 673,767 over 9 divided by the 500,000. Okay, and that gives us a profitability index value of 1.34. Now, because it's greater than 1, the project is acceptable. If you had 2 projects sitting beside one another, as we would in a sort of a capital rationing sort of scenario where we've only got so much capital and we'd have to ration between them, then we would opt for the project with the higher profitability index. However, it doesn't really give you a dollar amount in terms of the actual wealth you'll generate for the company. So what does that 0.34 represent in terms of wealth? In which case, I'd invite you to go back and use the NPV as a way of ascertaining how much extra money the company will get over and above the return that it requires. Okay. The strengths and weaknesses of each of the capital budgeting technique are NPV. It considers time value of money, it measures the project in dollar terms, and it gives you a clear decision criterion. If it's positive or zero, you accept, and if it's negative, then you reject. Okay. Now, weaknesses are that the cost of capital, discount rate, required return, however you'd like to call it, that is quite a subjective number. When you go into sort of looking deeper into corporate finance, you might find a kind of you'll find we do employ ways to try and remove that subjectivity as much as possible. The cash flows are assumed to be reinvested at that cost of capital, which may or may not be able to do that. And the last point is really in terms of communication. For the uninitiated, NPV doesn't make a lot of sense. It's very difficult to sort of communicate this number to people without financial training. So that's kind of why it's certainly the most accurate and it's the most reliable. However, it sits alongside IRR in terms of popularity simply because of that communication ability. So the strengths of IRR, internal rate of return, is that it considers your time value of money, gives you a clear decision criteria. Your IRR needs to be more than your cost of capital, okay? Because remember, greater than or equal to, okay? Because remember, your cost of capital, if it's less than that, produces a negative NPV, so that you wouldn't accept that. So it's relatively easy to understand as a figure itself. You can communicate it to non-financial audiences. Now, the problem with IRR, when you have complex projects where cash flows are negative, so in some years, then you will produce multiple IRRs. In other words, you'll have an IRR you can produce two different values for the IRR, and therefore it's very difficult to kind of square that circle. So what you would do in that instance is that you maybe just don't use the IRR. You assume your cash flows are reinvested at the IRR rate, which may or may not be realistic, and IRR doesn't give you a dollar measure like the NPV does, and you might actually want that. I would personally just do IRR alongside NPV. And so for those who are who don't have the finance training, at least that's a number they can grab onto. Many people who don't have finance training, what they'll first opt for is the idea that how quickly they will get their money back. So effectively, payback period is sort of a popular measure, okay? And it's simple and easy to calculate, okay? Relatively easy to understand. How long does it take to get your money back? It focuses on the timing of cash flows. Problem is that it ignores the time value of money, and it doesn't actually give you a dollar measure for the value of the project. And some projects are late bloomers. Some projects don't do as well initially and then do very, very well later on. So if you had a relatively short payback period stipulation, then you may reject good projects on this basis. The profitability index, okay, again, strong because it considers time value of money. Gives you an indication if you kind of convert it, you can have a dollar measure, but that's essentially looking at an NPV. It gives you a criteria for acceptance, so you'd have to be more than one. But its weaknesses are pretty much the same as IRR and NPV, about the reinvestment rate, and it's simply the cost of capital is an estimation rather than something hard and fast. There's an element of subjectivity there. But it can be often difficult for financial managers to understand. Let's look at the next question. And this question looks at the relationship between NPV and IRR. So suppose you are a company and you're considering investing in a new project that requires an initial investment of $1 million. And your expected cash flows are year 1, 300, year 2, 400, year 3, 500, year 4, 400, and year 5, 300. The cost of capital is 10%. So the first question asks you to calculate the NPV of the project using the cost of capital. I think I may have to escape from this in order, excuse me. The second question is calculate the IRR of the project, and the third question, describe the relationship between NPV and IRR. Explain how the company should use NPV and IRR together to make a decision about whether to invest in the project. So again, we are sort of looking at a situation where I've given you an IRR example, but you will not see an IRR calculation in the final exam. Okay. So NPV calculation, again, it's fairly straightforward by this stage. Remember, bring everything back to present value terms and net it off against your $1 million at the start. And we see the NPV value is 438,444. The project is positive in terms of NPV, so therefore it's acceptable. The IRR, we get an IRR of 25.75% because we've used our calculators. You could use a trial and error, and just to remind you again, if you are interested in looking at how the trial and error is done, refer back to the class notes that we have for topic 4. The relationship between NPV and IRR, they both give you the same accept reject decision. Okay. So that's pretty good. So if the NPV is positive, that means the IRR will be greater than the cost of capital. Remember, it's when the NPV is 0 that the IRR equals the cost of capital. Okay, so that gives you that. Okay, so it's fairly straightforward. If the NPV is negative, your IRR will be less than the cost of capital, meaning that the project wouldn't be acceptable. Okay, so and the final question is the company should use both. The answer to that is the company should use both NPV and IRR to decide whether to invest in the project. Okay, you would use NPV and IRR as an acceptance criteria. You won't find NPV and IRR delivering different results unless, of course, there are negative cash flows affecting the IRR, in which case you don't use the IRR. So you put them together. It's more communicable, it's more understandable, and it's what we see in the industry. So looking at the next question, which has to do with payback period, a company is considering investing in a new project that requires an initial investment of $500,000, and we see the expected cash flows 100, 150, 200, 250, 300. And the payback policy is 3 years. So first, calculate the payback period, evaluate whether the project is acceptable based on the payback period, and discuss limitations. Now that's a typical question that you could get in the exam. So the solution is, obviously, first of all, you need to know how to calculate the payback period. So you count all of those years before the full recovery, and then in the last year, whatever's unrecovered at the start of the year, you divide that by the whole cash flow during the year. So given information, we get 3 years. Where did we get those 3 years from? So year 1 was 100, year 2 and year 1 is 250, year 3, year 2 and year 1 is 450. We've still got 50 left. So we put that 50 there and we divide it by what we would have received in year 4, which was 250. Okay, and we do that calculation. It should give us, it should give us 3 years and 2.4 months. Okay, because whatever the decimal value is, you multiply it by 12 and it will give you the number of months. Now, if you just simply give me 3 point something years, then I will accept that as well. Okay, so the payback period is 3 years and 2.4 months. Okay, so the project is unacceptable because it's more than the 2 years. Okay, it's more than the 2 years, which was our criteria for acceptance. And that brings up our first limitation. Okay, well, it's not our first limitation actually. It brings up one of the limitations, in that we do not consider this. The payback period is an arbitrary decision. Okay, so what other limitations are there with the payback period? Lowers the time value of money. We don't get a discounted version or a discounted present value of those future cash flows. Any cash flows beyond the payback period are ignored as well, so you could miss out on some very good cash flows simply because you haven't looked any further than your arbitrary cutoff date. The risk of the investment is not considered either. Time value of money, remember, it considers the risk of the investment. It doesn't give you a measure of profitability. Okay, so that's problematic too. And there's no size of the investment. There's no way to consider the size of the investment. Okay. Using NPV and payback period to assess project viability. So let's look at this example as well. So this is just another example using NPV and payback. Company is considering investing in 2 different projects, X and Y. Okay, we've got an initial investment of 500,000 and we expect that it'll generate 100,000 per year for the next 6 years. Okay, project Y requires an initial investment of 800 and is expected to generate cash flows of 200 per year for 5 years. Cost of capital is 10%. So, first of all, we ask you to calculate payback period, then we ask you to calculate NPV. So payback period is the initial years for project X. That's 100 per year, 5 years, so that's 5 years. Okay, 100 per year, it'll take us, and we've invested 500, so that'll take us 5 years. Project Y, we initially invest 800 and it will take us 4 years because we have cash flows of 200 per year. So you would go for either the payback period with the shortest amount of time or that which corresponds to whatever arbitrary number we've given it. So if you're just looking at payback period alone, project Y seems like the better investment. But because it doesn't take into consideration the time value of money, let's see what we do when we calculate an NPV value. So our NPV value is calculated as we usually would, and we see that in project X we've got a negative NPV value of 64.73, and for project Y we've got a positive NPV value. So, we've also got a negative NPV value. So based on the NPV, actually neither investment is feasible. Both fail to generate an NPV of 0 or above. Okay, so it's just really a demonstration that your payback period is not enough to make that call. Okay, you would have, if you were just using payback, you would have gone for the project X, you would have gone for project Y, when neither is feasible. Okay, the next thing that we want to look at now is profitability index. So again, we've got our initial investment of $1 million. We have our 5 different capital flows. Okay, we see the cost of capital is 10%. Okay, profitability index for the project. It's see if it's acceptable based on the profitability index, and discuss the usefulness of the profitability index. Again, classic questions that you'd get. So calculating the profitability index, we use an NPV calculation, except we don't do the netting off at the end. So we bring all cash flows back to present value terms. Okay, that's what you need to do. So we treat each one of those individually, bringing each back to present value terms and then adding them together. Okay, and then we divide by the initial investment. For B, deem it to be acceptable if it's greater than 1. Also, it's acceptable if it's 1 as well, okay, because it gives you the required return. And for C, let's talk about the usefulness after we look at the calculation. So, solution A, again, this is NPV calculation, just as you'd expect, everything going along as you'd expect it to go along, and we see our present value of 1.438 million. Therefore, when we divide that by the initial million invested, we have a profitability index of 1.438, greater than 1, so we accept. And how is it useful? Why is it useful? It takes into account the time value of money, gives us a measure of return per dollar invested. So every dollar invested, we get $1.43 in return. Okay, so it's understandable that way. It allows us to compare profitability across different projects as well. So that's its greatest strength. Okay, it doesn't take into account the size of the investment, it takes into account risk in terms of it brings things back to present value terms. But you can draw a question over the cash flows themselves as to whether those cash flows would be whether you can rely on the cash flows or whether there's any subjectivity involved. Okay, so when you're using profitability index, always use it in conjunction with NPV and IRR. So we'd expect to see capital budgeting questions appear in the exam. You will I'm just trying to think. Yeah, I'll need you to demonstrate understanding of IRR. I'll need you to be able to calculate payback. Now, there won't be a formula for that. I'll need you to calculate NPV. Now, you'll be able to glean the formula because NPV is simply a present value calculation, but you'll need to know how to do that yourself. Profitability index, you'll need to know how to calculate that yourself. Okay, so that's all we have for now, and we will see you. Okay, we'll do that. We'll see you in the next video when we will talk about topic 5.